Hello everyone, and thank you for joining us. Welcome to this AutoVista Group webinar on the impact of COVID-19 on the used car market and what may happen in 2021. I'm Phil Curry, editor of the AutoVista Group Daily Brief, and today's event will see some of AutoVista Group's top experts bringing you information on economic scenarios and regional insights from across markets in Europe. Now, a couple of notes before we begin. Firstly, this session is being recorded and it will be made available to you all afterwards. So don't worry if you miss anything in today's presentations, you will have the opportunity to go back over things. Secondly, on the left or right hand side of your screen, the chat function is open. Please do use it to ask questions. We may run out of time to answer these today, but they will be taken and our experts will answer them, with some of those appearing in the AutoVista Group Daily Brief. Now, the Daily Brief is a free newsletter that delivers news analysis and industry insights directly to your email inbox. Rather than simply presenting what is happening in the automotive industry, AutoVista Group's experts, along with the dedicated Daily Brief editorial team, present analysis of the latest news stories and industry trends to give you a better insight into the impact of such events. There's also an increasing amount of multimedia content, such as the AutoVista Group Daily Brief YouTube channel and the AutoVista Group podcast, which brings you a deeper look at some of the bigger news stories happening. This is available on Apple Podcasts, Spotify, Google Podcasts, and now Amazon Music. You can sign up for free to the AutoVista Group Daily Brief at www.autovistagroup.com/sign up. Now, today our experts are going to be discussing a number of topics, including whether economic outlooks have changed in the wake of a second wave of COVID-19 infections, the rise in awareness and adoption of greener vehicles, the impact of incentive schemes on used vehicles and the mixed picture being seen in Europe, and changing recovery scenarios as we move into 2021. Now, we all know that 2020 has been a difficult year, and the European new car market has been in a state of flux since the first national lockdowns were introduced in March of 2020. With sales collapsing, the industry has been trying to rebuild ever since. However, while incentive schemes have helped to boost sales in some regions, especially as we can see here in France, Germany and Italy, the pandemic has had a big impact on consumer confidence, while resulting economic turmoil means spending power of the consumer is also heavily affected. This can be seen in Spain, which is the only market in Europe to introduce an incentive scheme but not see positive growth in registrations from it. The country registered increases in July prior to incentives as pent-up demand carried the market forward. As we can see, all markets posted a decline in October as a second wave of infections hit Europe. For November, things will skew again. The UK and France are going into a total lockdown with car dealerships closed. Germany is introducing a lighter lockdown that will see hospitality and public hotspots closed, but dealers remain open, while Italy and Spain are currently continuing with regional closures. But COVID-19 has provided an opportunity for the automotive industry in the shape of a green recovery, much needed at a time when car makers are facing steep fines should they peak over an average target of 95 grams per kilometre of CO2 emissions set by the European Union for 2021. So far, the biggest increase in the fuel type figures produced by the European Automobile Manufacturers Association shows that electrically chargeable vehicles, those that can plug into the mains, have seen an increase of 211.6%, while hybrids themselves are up 88%. In contrast, petrol sales are down 38.3% year to date, while diesel, which has been sliding since the Dieselgate scandal and the subsequent demonisation of the technology, is down 35% year to date. The petrol decline is more dramatic as it has been the market-leading fuel type up until now. Of these electrically chargeable vehicles, battery electric models are up by 71.7%. However, the growth has been mostly provided by the plug-in hybrid sector. With an increase in models, coupled with incentives for greener vehicles and consumer desire to have something that is incentivised, but still able to provide the range of travel they are used to, sales have grown 221%, from 87,000 units in the first 9 months of 2019 to 280,000 units year to date. Growth in the third quarter alone was 368%, tying in with many markets introducing low and zero carbon vehicle incentives. Therefore, there is an appetite for greener vehicles, and the financial help offered to consumers to purchase such a vehicle in the wake of COVID-19 and the resulting economic impact is helping to drive the market forward in new electric vehicles for now. Now, I'd like to hand over to Alta Vista Group's Chief Economist, Christoph Ingelskirchen, who will discuss the impact of a second wave of infections. Christoph.
Thank you, Phil, for these introductions, and I'm very happy to be in this webinar with all of you guys. I would like to hand over to you, to all of you, and I would like to start us off with a quick poll. And it's a little bit like a pulse check, and we will contrast these results to the last two polls that we ran in July and September, and of course also our view. So the questions that we would like you to ask was just one question actually. Which shape of economic recovery for Europe is the most likely from your perspective? So is it a swift V-shaped recovery, a moderately quick, still V-shaped recovery, or do you think it's rather a slow U-shaped recovery? Are we talking about a deeper recession with a slow recovery, or a very deep recession, more of an L-shaped type recovery? And please cast your votes now, and maybe we give you 5 more seconds. It's all anonymous, and but it'll help us contrast the results this time versus the last 2 times that we did it. So could we see the results? So we have 1%. I'm just taking notes because this is all live, obviously, and very interesting to contrast in a second. So 1% scenario 1, the majority is still looking at a U-shaped type recovery. That's, I guess it's the easy answer. V-shaped recovery, a moderately quick V-shaped recovery is actually second, coming in second now, and the deep recession is at 15%. So if we move to the next slide, please. So this is where we contrasted September's poll with July's poll. And we could see that between July and September, so September is the dark blue bar, we could see people becoming a bit more pessimistic. So scenario deep recession, slow recovery moved to 34% from 14% in July. And if you now contrast this to this poll that we just did together, we still have 52% scenario 3. So the U-shaped recovery is still the majority, but this negative scenario 4 has actually come back down to 15% now. So it's more comparable to July, when I think people were in still in a more, let's say, positive mood. And I think the news about the vaccine may have tipped the scale here. And scenario 2 is at 32%, so still confirming a more optimistic view now than in September. So if we move on, I'd like to contrast this with the economic outlooks that have been produced from various institutes, and we can see that for 2021, this is the charts on the right side of this page. So these are the outlooks for 2021, and we can see that the gross domestic product for the Eurozone has come down to 4.1%, which is the latest outlook from the EU Commission, 4.1% growth in 2021. In July, things were looking like they were going to be a bit more elastic, a bit of a quicker recovery. So, but still, November 5, with the latest outlook from the EU Commission, may not fully reflect some of the more positive news that we have seen. In terms of vaccine development, there was another positive message coming in just today, right before this this webinar. And for 2020, just to summarize what happens this year, I mean, hopefully people are able to forecast in November pretty much consistently what's going to happen this year, and we will see decline or contraction of around 8% in the Eurozone. This means some markets will be hit much worse than this, and others a bit less. But 8% is a hefty contraction that we will see. And yeah, with that, I'd like to move on to the used car market performance in 2020. So this is the last webinar on COVID-19 effects that we will run this year. And we almost have the full view of what happened in 2020 with residual values across markets. And the good news is that most used car markets perform better than before the crisis at this point in time. And on this chart, which is from our COVID-19 tracker, we show price indices by market. Pre-crisis level was set to 100, so we put everyone on the same starting point before the pandemic hit the market. And you can see how we saw some swift downward reactions by some markets. Yeah. So those markets that didn't have lockdowns, so Finland and Sweden in particular didn't have a lockdown at all. I mean, Finland had some, but the dealers remained open. They saw an immediate reaction around April, May, June, downward reaction. Portugal as well, also quite quickly affected. But all of these three markets have moved back to the 100 line almost, and Sweden even far above. But the majority of markets that are centered in the middle of this cloud of curves, they haven't seen a big reaction over the summer because there was a lockdown and prices didn't change during closure of dealers. But then towards October and now November, we see a good performance across markets. France, which is the blue line, the darker blue line here, fared particularly well because incentive schemes covered used car buying as well. And in the UK, we have a bit of a, let's say, it's not such a positive story in the sense that what's driving this red line's increase in prices is fear, right? It's fear of no deal Brexit. It's fear of a weakening pound. It's the desire to have a safe transport alternative, supply shortage, in particular in the UK. So there we can see, the three types of recovery as we speak so far in 2020. And moving on, it's important to look one level deeper because we need to understand why are markets moving in that direction and how long this will be able to continue to go like this. And what we can see is that in most markets there is a big difference in how budget cars are developing in the crisis and how young used cars, the ones that are, let's say, more expensive, that are more valuable for the industry in terms of performance, are behaving. Here is Sweden as an example. You see the performance by age cluster in Sweden, and the young used cars and the very young used cars, so 0 to 6 months and 7 to 17 months, they haven't been rising. And lately they have even been stabilizing or falling again. And the budget cars, so in particular 91 months and older used cars, they are really driving the good performance of used car markets at the moment. If you want to find out more, you can always download our white paper, which has just been updated today. The link is on all of these pages on the bottom left. It's on our corporate site, and there is a coronavirus gateway link, and you can click on it. So we have updated our residual value outlooks in November, and what I'm showing you here is the expected speed of recovery in our November outlook for 2020, 2021, and 2022. That's on the right side of the chart versus our September outlook. This is how we saw things evolving when we last published this white paper in September. And the question is, what has changed? So first of all, there is less pressure in 2020 than expected. And Jen, if you click once more, we can see that there's less pressure in 2020 than expected. So the drop that we anticipated in this year is going to be, there is going to be some pressure still that you can see from this chart, but it's going to be less impactful than what we thought in September. So markets have stayed more resilient than we thought in September. And we also expect a more elastic recovery in several markets, especially in Central Eastern Europe. That's a cluster which sees quite an elastic upward movement over the next 2 years, also for exchange rate reasons. Northern Europe is faring quite resiliently. Finland, for example, they haven't really seen a second wave of the infections hitting them. And then if we click once more, we can see that we do also have several markets that will still be under pre-crisis levels towards the end of 2020, and that is in particular Southern Europe, which will see more negative impact still, and the UK as well. The DACH region is a bit differently affected. Not as bad as Southern Europe, but still there is pressure downwards. And on the next slide, we can show you a bit why we think that in some of these markets we will continue to see pressure evolving. So the chart looks a bit dense, but it's 18 countries that have installed some. It's actually not 18, but around 16 countries that have installed incentive programs from the governments. And the main idea is to stimulate new car sales, and that's shown on the left part of this chart. Yeah. So with pluses, we've indicated the various elements of these incentive schemes and how much they stimulate new car buying in the countries. And you can currently get around 4 to 10K of government-funded discounts when you buy electric vehicles. BEVs are more subsidized than PHEVs, and ICE engines are not, or they do not receive a similar government attention in most markets. And what we have done here on the right part, the more colorful parts of this table, is we have shown what pressure those incentives mean for residual values for the two powertrain types. So on the left side, the electric vehicles, on the right side, the internal combustion engine. And first of all, the majority of schemes, they push a lot of stimulus on electric vehicles. That's why we will see more pressure on them. And just to contrast two countries here, France, for example, you may be aware, a lot of incentives on electric vehicles have been granted for a long time as well already. The scheme has just been extended again. But the positive thing here is that they covered also used car buying in their scheme. And that has helped alleviate some of the pressure that we could still expect to materialize on electric vehicles in France. And France has been affected by that already, also over the past years with the incentive schemes. Germany has probably one of the more impactful schemes and more negatively impactful on residual values for electric vehicles in particular. That's where we've moved the cross to medium to high in the yellow area. You can get 10,000 euro of government support now on electric vehicles, and what we just fear, and this is reflected in our outlooks, we will hear from Andreas Gallenbrügge also, who's leading the team in Germany for Schwacke. There is going to be an imbalance of supply of electric vehicles on used car markets, and that's creating some sort of pressure that we will see materialize in residual values. And moving to the last page, I want to end with some risks and some opportunities. So there is still a risk that the economic recovery might slow down. or will be very different across countries. There is a new letter, by the way, which some people are using now. It's a K letter, so maybe we have different directions, or W indicating that we might have another drop in economic performance. Also, there is a risk that we see a rise in COVID-19 infections to triage levels, which would be devastating. I hope, and I think many of us hope, that the lockdowns, which are more differentiated now, will still have a positive effect. And the residual value risk for alternative powertrains, they are quite substantial. We don't want to create panic around it, because it's also important that we start stimulating demand for them. But the smarter governments, they do look at used car market stimulants as well, and that could be everything from infrastructure to rising fuel prices, taxes on fuel. So there needs to happen something in that area to manage that risk down. In terms of opportunities, the lockdown measures are much more differentiated, which is encouraging economically. Vaccine development is clearly a very positive news towards the year end. And if there's maybe one thing that we could say is positive about COVID-19, is consumers have become more open to change and also more open to new business models that are now being deployed and tested. And I think that's a positive takeaway that we can all leverage in our businesses as well. And with that, I'd like to move on and hand over to Anna Sofra, who is the Valuations and Insight Manager in Spain. Over to you, Anna.
Okay, thank you very much, Christoph, and good afternoon, everyone. Okay, since we started this analysis, we have updated our forecast twice so far, in May and July, as you can see in the graph above. In the first edition of our white paper, which was prepared at the end of March, we spoke of a slight impact of the pandemic on GDP that would affect the third quarter of the year and a V-shaped recovery. Consequently, we predicted a slight impact on RVs, mainly motivated by the increase of the promotional activity expected for the second half of the year. Shortly afterwards, as we explained in the first of this webinar series, the situation changed significantly, and the expected impact on RVs got worse in May. The impossibility of controlling the pandemic, the long and restrictive lockdowns, the lack of a more positive near future, and the expected fall in GDP, which especially in Spain meant a fall in employment and private consumption. Again, in July, we adjusted our forecast for the midterm 2021 to 2022. In addition to the gloomier economic forecast, the pressure on used car prices would be aggravated by the implementation of the government incentive scheme program for the purchase of new and young used vehicles. At this time, as you can see below, we have reinforced the idea of a U-shaped recovery, although we also slightly increased the likelihood of falling into a deeper recession, which would perhaps be more in line with the economic forecast of the IMF and other independent entities. However, despite of this forecast, it's true that the effect of the lockdown in the shortest term was less negative than expected. The automotive market experienced a momentum after the lockdown. Sales postponed because of the pandemic, and other sales that were brought forward with the optimism of the possible exit from the pandemic. The used car market was able to take even more advantage in this scenario. This positive effect was not the same across all age groups, as can be seen in this graph that shows the evolution of prices since March. Two age groups performed very well, the younger cars and the older cars, for completely different reasons. With respect to the former, the dark blue line, the used car prices show a more positive evolution because they somehow compensated the shortfall of new cars as per the halt in production. Additionally, very important in Spain, there were fewer cars coming from rent-a-car. In total, we are talking about a stock reduction of more than 50% after the lockdown, On the other hand, the number of vehicles coming from leasing channels was higher, which usually favors the used car average price. With respect to the latter, cars over 7 years old, the green line above in the chart, the reasons are very different. In this case, the best evolution is more related to the crisis, with diverse demand towards cheaper vehicles, and is also related to the transfer of former public transport users to individual mobility, let's say own car, as it's considered safer and more hygienic. The shortfall in the offer was also due to the fewer trade-ins as a result of the fewer new car sales and the implementation of the Renove plan, which encourages scrapping and reduces stock. And because this had, on average, positive effect on prices, we have now softened the impact on residual values for 2020 to negative 4% compared to March. However, since the beginning of September, as can be seen in the most updated data in the graph highlighted in yellow, offer prices show that the trend is reversing, including the 8 groups just mentioned. Therefore, we are maintaining the RV's impact for the next 2 years, negative 5%, as there are some signs of weakness that are affecting prices. First, the slowdown in demand. Although forecasts of falling sales for new cars, as well as used cars, have improved compared to May, they remain negative. Both the volume of stock and the number of days in stock are increasing, even those younger groups that are not facing the rent-a-car deflates. And some risks remain. The second wave of the pandemic is not yet controlled, with intermittent regional lockdowns, and so the economic prospects are worsening, with a minus 12.8% fall in GDP, according to IMF. The unemployment rate has already reached 16% and is still rising. The incentive plan that boosts sales of new cars penalizes residual values in the future. We are estimating low pressure for IC vehicles that could increase if the plan is extended, and from low to medium pressure for EVs and PHEVs, as the incentive is higher and the market is not yet mature. And last but not least, the implementation of WLTP in January 2021 could increase the list price of a large part of the model's currently on sales, since our tax rate is based on CO2 emissions. This could lead to additional negative effects on the market. The industry has called for changes in the taxation, but there are not updates so far. And this is all for Spain. We now turn to our neighboring country, Portugal. Let me hand you over to my colleague, João Areal. Thank you.
Thanks, Anna, and good afternoon, everyone. I will now speak about the Portuguese market. In this current situation, we have 2020 GDP to drop 8.5% and unemployment rate increasing to 8.7%. No new car incentive schemes expected to 2021. This is what we have now in state budget proposal, but yet in discussion. Number of COVID cases is rising, higher than in April, and government is trying to avoid a full lockdown. But we have now a partial one from 11 p.m. to 5 a.m. and at weekends also in the afternoon. We confirm scenario 3, U-shaped recovery, as most likely scenario, but we need to wait for the impact of this second wave in the economy. As market situation, we had a drop of 36.3% in new car sales. This is until October. However, plug-in hybrid had an increase of 89.6%, almost double, and without any new incentive. Electric vehicles maintain the number of sales. Used car transactions decreased 11.6%, but in June and September were the exception, where we had an increase of 6.2% and 7.3% respectively. This is numbers until September. And also number of import used car dropped almost 25%, also until September. And now the RV impact assessment. COVID-19 lockdown induced a sharp fall in the residual values of 3%, as you can see on top left chart. Values have been increasing since end of May 2020 and almost reached pre-pandemic values in end of October. Similar behavior in all vehicles ages, with the exceptions of vehicles up to 6 months old that reached and exceeded pre-pandemic values in June, the blue line on bottom right chart, and 91 months and older vehicles that took more time to recover, just began in end of July. It's the green line on same chart. When comparing with September white paper, we say now that 2020 will see a lesser RB impact than previously expected. We have now a drop of 1.4%. For 2021 and 2022, no change from now. We maintain -2.1 and -2% respectively, as you can see on bottom left. Thank you for your attention. And now I would like to hand over to my Romanian colleague, Ulmis Orsidan.
Thank you all. Hello, everybody. Let's look at the situation in Romania, please. So Romania was under a strict lockdown from the middle of March to early June, and this measure took a rather heavy toll on the economy. So the IMF sees the GDP drop for 2020 at almost 5%, but in the same time, they see some good news because we are heading towards recovery, almost full recovery in 2021. Unfortunately, because of the tough measures, unemployment skyrocketed from almost 4% to 8%. And the same entity, IMF, sees that this figure is going to go down in 2021. The number of COVID cases are rising steadily, and there are now around 10,000 cases on a daily basis, and we face a possible new lockdown soon. We consider scenario 4, as defined as medium-high risk, deep recession and slow recovery, the most likely scenario. However, we have updated our percentage based on also on the IMF forecast. Looking at the market situation, we have strong new car sales incentives, so 60,000 vouchers, each worth a little bit over 1,300 euros in order to discard an old vehicle and buy a new one, in order to renew the car park and stimulate the economy. Hybrid sales are up 55%, and battery electric vehicles are up 30%, supported by some of the biggest incentives in the European Union. However, new passenger car sales, January to October, stand at -28%, and the LCVs were just a little bit better, -23% compared to 2019. Looking at the residual value impact assessment, so used car values took a nosedive during the lockdown, as was mentioned previously, mid-March to early June. Dealers advertise prices at -20% in some cases, while private individuals lower their asking prices by around 4%. Once the lockdown was lifted, prices slowly went back to pre-lockdown levels, driven mainly by the growing need for mobility and a drying up of stocks. Used car imports are -60% compared to the same period of 2019, mainly because of travel restrictions. However, in terms of pure units, we are talking here about -60,000 units, which is a lot. Residual value threats. Common practice is to offer discounts for new car sales. This is still present. However, various brands offer special pricing, and this seriously dilutes the residual values and in the long run damages the brand image. There is some good news also regarding mobility support, because fuel prices have steadily gone down. In conclusion, Romanians face an uncertain economic future, and they weigh extremely carefully their need for mobility and the investment that this means. That's why residual value impact is still on the negative side. Thank you for your attention, and now I'm handing over to my German colleague Andreas Geilenbrugge.
Yeah, thanks, Ulmis. Let's leave some words about the German market. Well, in Germany, we have experienced a situation in the past 8 months, which in several places has undermined the usual market mechanisms. So it was quite unusual to observe from the perspective of a used car and RV provider. In July, for example, temporary reduction in VAT and the increase of the battery electric and plug-in hybrid bonus led to a reduction in the level of transaction prices for new cars, which is always also having a creeping effect on used car prices because it's cascading down. However, the decisive factor for the development to date and in the near future has been the interplay between production stop, availability of young used cars from the previous year, and some catch-up effects after the quite short German 8-week shutdown that we had in March and July. And what happened is that dealers acted very calmly and prudently with regard to prices. So this is why we came quite stable through this period. This reduced but still existing and unmet demand for new cars was partly compensated by young used cars. While older vehicles are popular with people who no longer want to use public transport, and both these factors unusually make used cars a seller's market at this very moment, pushing prices or at least having prices being stable. The economic forecast for the coming years, also due to the second wave that we are somehow facing currently, has developed slightly worse than expected and will reveal the consequences for especially the domestic economy and thus purchasing power, unemployment rate, etc., only with a time lag in the next year for some structural reasons. And for these reasons, we have adjusted our forecast moderately, improved it slightly for this year, and revised it downwards for 2021 in particular, as it will be the negative peak, as we think. So on the current stock day figures, they show that there is a growing proportion of, let's say, leftover vehicles, and this will generate some pressure on the existing stocks on the dealership. In addition, the dealers still have to cope with a loss of 25% of their new car business compared to last year, which means more than 350,000 fewer cars sold to end customers. And even as these are September figures, even the October just got a little bit ahead of it. So it's still around about 350,000 minus vehicles for this year. So this means massively less revenue in their books. And this cannot be offset by the used car business, which, although running well, given the circumstances, is still down on the previous year and is not balancing this gap. Furthermore, in the coming years, new car registrations of battery electric vehicles, plug-in hybrids, becoming more and more important, which are comparably cheap due to the premiums, will have to be traded in. And as you can see on the graphs, they have risen sharply. So if you take a look at it, the right colored columns represent the growth in absolute figures, while the darker columns show the total number. So you can see how much it was pushed by this premium or by this incentive scheme. So in our view, the dealers do not really seem to be prepared for this business, yet getting additional pain and pressure coming on top on the COVID topic for the next year. So after a relatively mild 2020, the real critical year from a German perspective will be 2021, and only then will it slowly recover. If there are no other previously unknown influences that we not know now, but however, keep fingers crossed that we get through it in a good way. So saying this, I would like to hand over back to Phil Curry to make some conclusions. Thanks.
Thanks, Andreas. So, in conclusion, Europe is now in a second wave of coronavirus infections, with different markets taking different approaches to vehicle sales during new national and regional lockdowns. This means that sales figures across the continent will vary in the run towards the end of the year, with some markets obviously stopping sales, others continuing. Economic outlooks for the Eurozone in 2021 are slightly more depressed, having come down since July. Most used car markets are performing better than they were before the crisis hit, but these are driven by a run on budget used vehicles. Government incentives are putting pressure on RVs, especially with electric vehicles. In the market, Spain has softened its negative RV impact for 2020, but risks remain, including negative GDP and unemployment rates. While Germany saw young used car numbers thin as production halted in the first wave of lockdowns, but the country is back to pre-crisis levels. The country is also keeping its dealerships open during a second wave lockdown, unlike some other territories. Now, before we conclude, I would like to draw your attention to the AutoVista Group Daily Brief's Brexit Survey. We want to know how Brexit is affecting your business. Does it provide an obstacle or an opportunity? What would be the best trading scenario between the UK and Europe? And how will Brexit impact technology and regulation developments, plus more? Whether you're based in the UK or Europe, please do help us to understand how this major economic and political shift is affecting you and your business. Take a note of the URL that is on the screen or click when you receive the slide deck for this presentation. We really do want to hear your thoughts. Finally, AutoVista Group's Residual Value Intelligence gives you detailed information that can help you to steer your business through these challenging times. This tool allows users to review trends and gives real context to analysis by interrogating dashboards on the 5 big markets, 14 vehicle segments, 7 fuel types, and 38 brands. To find out more and request a free 7-day trial, please contact Tim Budgin, whose details are there on screen. Also, if you have any questions concerning anything you've seen in our webinar today, the contact details of our experts are also listed there, and they will be happy to help where they can. And last but by no means least, this information is also presented in our white paper, How Will COVID-19 Shape Used Car Markets? You can find a link to this, as well as the sign-up form for the AutoVista Group Daily Brief, by visiting www.autovistagroup.com and clicking on Coronavirus Gateway in the top right-hand corner of the screen. For now, I'd like to thank you all for joining us, and please do stay safe. Thank you.